delta do we pick? So today we're going to continue our exploration of the zero DTE options by researching the following question. What strike should I choose if I want to buy a zero DTE put? Do you want to change your answer?
No.
In this segment, we are sticking with index ETFs. We're going to use the SPY, and we'll study 3 days, each with a different size down move, and purchase zero DTE options with different strikes. So the goal is to develop expectations and mechanics for those who want to play zero DTE options.
To give you an idea, that Delta option has about 70 cents in premium in it. You're only paying $2 or less for it.
This is for people that want to play zero DTE with small, with small sizes. Mm-hmm. Ready? Let's go next slide. So we did a study, and we looked at intraday option price data for days that the market sold off 1%, 2%, and 3%. And just remember, the market doesn't sell off 3% very often. Mm-hmm. I think it's like 1% of the time. Mm-hmm. So 1% would be 40 handles in the S&P. Well, actually, yeah, 40 handles in the S&Ps, and 2% would be 80 handles in the S&P. So 2% doesn't happen that often. Mm-hmm. These roughly equate to 1, 2, and 3 standard deviation moves, roughly. Mm-hmm. We bought the following for a debit: an at the money, a 25 delta, a 10 delta, and a 5 delta put. Okay. So you can't have your in the money put. Would you like to change your answer?
I'll go at the money.
Tony goes at the money with his answer. Computed the following: the closing price of each zero DTE put as a multiple of the debit paid on the opening.
Now, I like what they're doing here, and I like where they're going, and I know I can see how the results are going to happen by the way it's setting up. But they're looking at things at the end of day. What I want the research team to look at, and I'm talking with them, is that I want to see, like, intraday, what's the opportunity of making 25% on your money? And at the money option right now, the 193 strike with the stock at 193.70 is $1.60. How much does that $1.60 go to 220? Something like that. That's what I want to see them do. How many opportunities you have if you're directionally right. But go ahead. We'll get there.
Okay. Go back, John, 1 second. I have to give him one more chance to change his answer. So you still want your same answer?
I do.
Okay. And then we computed everything at the closing price of each zero DTE options as a multiple of the debit paid, because we're not as good as Tony. We can't figure out exactly when to sell it intraday. Let's go to the next slide. So I just got an email, by the way, from Mama Bear. She said, be nice to John.
Be nice to who?
John.
Oh. Oh, no.
John, you got Mama Bear looking out for you.
Thank you, Beth.
I just said he was a pocket passer. I mean, I didn't say anything bad.
Yeah, but some people don't know what that means, and it could sound a little bit,
No.
When looking at 3% down, he's not a scrambler.
He's not a scrambler.
Yeah, no.
Right.
When looking at 3% down days, the largest multiple gain was on the far out of the money options. These are on 3% down days, the 5 delta, with a gain of nearly 25 times what you paid.
All right, but you're paying 10, 15, 20.
However, these moves occur less than 1% of the time. So you can't play for that.
Of course.
Since
3 standard deviation moves are near impossible to play for, let's review the results of 1 and 2 standard deviation moves, which are more realistic.
Okay.
So on the bottom, this is the first thing we're going to look at is the size of the intraday sell-off. We said 3%, which again doesn't happen very often. The at the money options, you made 5.5 times. The 25 delta you made 10 times. The 10 delta you made 20 times basically, and the 5 delta you made 25 times.
This is almost like looking at return on capital.
Yes.
This is
But this is unrealistic because this only happens less than 1% of the time.
Exactly.
Way less than 1% of the time. Let's go to the next slide. So now we're going to get into more realistic stuff. This is the same far out of the money options that return 25% on 3% down days, actually expired at 0 even on 2% down days. So, because we're doing zero DTE options. So on the 1% down day, which occurs 15% of the time, remember 1 standard deviation move, 16 deltas, 15% of the time,
Sure.
Perfect, right? Math works. Both the 10 and 5 delta puts expire worthless, but the 25 delta put closed at roughly 3 times. So we looked at these things. We looked at zero DTE options, and we looked at the closing price as a multiple of. We found that the best bang for your buck was actually the 25 delta option on a 1 or 2% down move. Okay, listen, it's
I know,
pretty
but again,
straightforward.
we're still playing for that 15%.
I understand, but it's still the best bang for your buck was that middle column, that 25 delta. Let's go next slide. So if you want to trade 0 DTE puts in anticipation of a down move, a reasonable strike to start with could be the 25 delta. If you get the desired 1% sell-off, which happens 15% of the time, you would see the put trade at 3 times the debit paid. And it could trade up to 10 times the debit paid in the event of a 3% outlier. In the next segment on 0 DTE options, we will compare trades on underlyings with much higher implied volatilities, underlyings with higher implied volatilities. Okay, is that the last slide, John, or is there one more for takeaways? Takeaways. For those wanting to trade 0 DTE options, you could potentially look at the 25 delta puts to play the downside. A 0 DTE 25 delta put that returned 3 times the debit paid on a day where the market sold off 1% intraday. This is roughly equivalent to the average day's expected move in the SPY. So trading even cheaper puts will result in more trades that lose money, even if you get a down move. The 10 delta puts needed to close to a 2 standard deviation move to see a return, a positive return. So the answer here is if you're playing directional, we're going to lean at that 25 delta.
I like it. I like
Research says.
I like where they went with it. We need more. We need to do more. I want them to look at selling out of the money spreads. Just from hearing what you're saying here, great. Then let's sell those 15 delta, those 10 delta calls and puts. Let's do it in a spread so that we have quote unquote defined risk, but really not using a lot of buying power. Let's look at them in SPX too. And do 1/10 the size. A lot of research to come. I really love the direction they're going. Let's take a quick 90-second break. We'll come back. We got more Tasty Live. Where are we going with this?
We got a special guest.
Is he here? I can't see. My back is turned.
Yeah.
He's here? Beautiful. Special guest, mystery guest coming up next. You listen to Tasty Live. I'm so happy.